first, news of the Dow's biggest drop of the year. We got Steve Russolillo here on the set to tell us about it, to bring the bad news.
Yeah, it was ugly out there. This was the worst day of the year. The Dow was down about 213 points. You really
there it
saw
is. That's a pretty straight line down.
Yeah, you know, we were dipping all day long and didn't really see any, real buyers step in to push this thing back up. And you could see there on the chart, it was just pretty much straight down all day long. There were a bunch of factors at play here. One, it got really messy in Europe. You saw European stocks took a sharp turn lower. Italian stocks were down. Spanish stocks down to a 3-year low. Just some really bad news. And bond yields, Spanish bond yields back up to 6%. That's the highest level of the year. So people are starting to worry again about Europe. And that's one of those things that's kind of been on the back burner for much of 2012. And so once those worries start creeping up...
2011 and 2010 and 2009.
Well, no, they've been on the back burner for this year.
They've been on a burner somewhere, though, haven't they?
Absolutely. So things are starting to get, people are starting to worry a little bit more about Europe. And I think you had some technical factors also at play here in the U.S. 1370 on the S&P 500 was a level that people were closely watching as a key support level. And once we fell through that in the afternoon, that was it. Yeah, you could see it on the chart that once you moved through that level, it was just straight down from there. So biggest sell-off of the year. We're down almost 5% from the highs earlier this month. We're on a 5-day losing skid. When you look at the big picture, though, that's coming off of a huge rally over the last 6 months. So you got to put it in perspective. But the point, though, is that it's been pretty ugly here over the last 5 days.
While David asks this question, let's get the oil price up. David.
I still think we need to take this in the context of we had a long holiday weekend. We had so much bad news right before the market was closed on Friday.
Right.
And I think people are coming back. I think Tuesday is really the day that they've come back. They have digested a lot of this news, the bad news out of Europe, the disappointing employment numbers that came out Friday.
And this oil price reflects all that, doesn't it, as well? Because
totally
you use less oil when the economy is bad.
That's right. And, I also think a lot of people have been digging into the labor numbers that came out on Friday, and now today they're starting to get a sense of it. I saw a report out of SageWorks about they study private companies, and they were looking at profit margins, and profit margins are very healthy, which is telling us that companies are doing more with less, and so they don't need to hire workers because they've been through a gritty recession that's made them a lot more efficient. And I think people are saying, hey, wait a second, the job growth is not going to come the way we thought it would, but profits may still be there.
Now, Steve, I know you didn't have a chance to respond to that, but never mind. I want to ask you about interest rates, because interest rates are another part of the story today. We got back below 2% on the 10-year long bond, the 10-year bond yield, which is really a sign that yet again calls of the end of the bond market rally are sort of much exaggerated. It keeps, every time it falls back, it keeps rallying again.
Well, yeah, let's put it into context also, as David said. This is what we've seen over the last 5 days is bringing back memories of 2011, but also we've had a huge run here in 2012. So I don't think anyone's getting too worried right now, but this is an interesting point right now for the market, because a lot of people were calling for a 5% pullback in stocks and saying, okay, the market can't go straight up forever. We need to have some sort of pullback, and then people are going to step back in. Well, we're at that point. Now, here's the pullback. Are people going to step back in? And the picture doesn't look so hot, though. That's the thing. Like we just talked about Europe. You have earnings which are essentially kicking off today with Alcoa's report.
We're expecting the Alcoa results shortly. We're expecting market expecting a loss of about 4 cents versus 27 cents profit a year before. They're also expecting a 3% decline in sales. Alcoa is important, Steve, because why?
Oh yeah, it's one of the biggest aluminum producers out there, and you want to just keep an eye on it as a sort of bellwether.
Okay, we just got it. Alcoa reported 10 cents a share, beating expectations massively, seen as a bellwether of the economy. Second, extraordinary. The expectations were a loss of 4 cents, so clearly beating by 14 cents, which is a monster win, if indeed that is the case. And we got the after-hours trading there up 4%. So what the reason is that people look at this is because it's in so many different businesses in the economy, and it's seen as a bellwether of everything. Is this a sign that earnings are just going to be great everywhere?
Well, I think that you have to keep in mind the earnings expectation game that's out there, and I think the analysts have set the bar so low right now for earnings that
that was pretty low. That was pretty low for them, right? -4 cents.
Right, exactly. So you have to keep that in mind that okay, companies can beat the results, can beat the expectations, but that doesn't necessarily mean that the results are so strong. So Alcoa that's a really great number, and that definitely you're seeing that reflected in the stock price. But I think as a whole, when we look at the earnings picture in general, analysts are expecting only 1% growth from a year ago. That's nothing compared to what we've seen over the last 8 or 9 quarters.
And I think it's also true that a lot of these earnings will come in and they will beat estimates, and they'll be strong. They'll be decent earnings. This isn't to say that your 10 cents versus a 4 cents loss is a bad quarter. But the reality is that companies have squeezed every last ounce of productivity out of their workers. They've squeezed whatever they can on materials costs, etc. And so companies are lean and mean right now, and still pretty well poised.
And actually, pulling back from this, we're seeing this 10 cents a share. Yes, it's profit, and it beat the expectations of 4 cents loss, but it's still down from 27 cents profit in the same period a year ago, which is quite a substantial decline. If you look at it that way, wow, your earnings shrank by 2/3. I mean, that is not really a great message to send to your shareholders. Oh, look, the economy is supposed to be recovering, and yet we shrank our profit this much.
I mean, you're right, and that's been reflected in the stock price. Alcoa hit a 3-month low today, and it's lost about half of its value over the last year. So, you're seeing in the after-hours market, a little bit of a bump up here, but still, it has a long way to go from where it's been. So, we get some other key earnings reports later this week. We get Google, JP Morgan. So, this is it. Earnings season is here, and
earnings season has kicked off, and Steve Russolillo was there to help us with it. Catch Steve and the gang live weekdays at 10:30 for the Markets Hub.